we're being told that policy is restrictive. The Federal Reserve has policy rates at multi-decade highs. Financial conditions are tight. And yet, equities are near highs, credit spreads are compressed, and volatility is contained. If liquidity were genuinely scarce, this would not be happening. So let's stop listening to rhetoric and let's start looking at the plumbing. Before 2020, the Fed's balance sheet was roughly $4.2 trillion. It's expanded since to about $9 trillion at its peak. Even after quantitative tightening, it remains trillions above pre-pandemic levels. Bank reserves today remain structurally higher than the 2010 to 2018 regime, and that matters. Because markets don't crash when liquidity is slowing, they crash when liquidity is scarce. We're nowhere near the reserve scarcity levels that triggered prior funding crises, and that's the first tell. Now, the key dynamic most commentary ignores, the reverse repo facility peaked above $2 trillion. The cash was parked at the Fed inert. The reverse repo balances declined, and that money flowed back into the banking system. Reserves increased, liquidity improved, quantitative tightening was partially offset mechanically. So while the headline narrative was the Fed is draining liquidity, the plumbing showed redistribution, not contraction. That distinction explains why markets absorbed rate hikes without systemic stress. The U.S. Treasury's cash balance, the TGA, directly affects reserves. When Treasury draws down its account, liquidity rises. When it rebuilds, liquidity tightens. Over the past cycle, Treasury management decisions materially altered reserve levels independent of Fed rhetoric. So liquidity isn't about QE versus QT. It's about the combined balance of the Fed, the Treasury, and the banking system. Professionals watch all three. Retail watches Powell, and that's the gap. So let's zoom out. Offshore dollar credit exceeds $12 trillion. Global trade clears in dollars. When dollar liquidity tightens meaningfully, stress appears in cross-currency basis markets, emerging market refinancing, and short-term funding spreads. So what have we seen? Episodic widening followed by stabilization. And why is that? Because central banks coordinate. The swap lines reopen, facilities expand, collateral frameworks adjust. The dollar system is not allowed to break, it is managed. And managed liquidity prevents disorderly deleveraging. Here's the uncomfortable arithmetic. U.S. federal debt exceeds $30 trillion. It's closer to 38. At current rates, interest expense accelerates rapidly. Globally, total debt exceeds 300% of GDP. A sustained liquidity concentration would trigger refinancing crises, reprice sovereign risk, and collapse asset valuations. That outcome is systemically destabilizing. So, policy must oscillate. Tight enough to preserve credibility, loose enough to prevent fracture. This is not conspiracy, it's just simply debt math. So look at behavior. Credit spreads are not signaling stress. Equity multiples imply stable discount rates, and funding markets are functioning. Markets are not pricing scarcity, they are pricing managed liquidity. That's why risk assets remain resilient, not because growth is spectacular, but because the system is being supported. If liquidity were truly restrictive, you would see reserve scarcity, funding stress, widening spreads, and disorder, but we do not see that. We do see controlled constraint, and until liquidity is allowed to genuinely contract, asset prices are unlikely to reset structurally. Watch reserves. Watch reverse repo. Watch dollar funding markets. Policy rates are theater. Balance sheets are reality. Thank you for watching all the way to the end. Tomorrow, we're going to examine part 1 of Ron Paul. Was he right? As always, Take care of yourself and each other. And as always, build that stack.